out on a beautiful day and not interrupt your picnic or whatever else you could have done tonight. But I think you're going to enjoy a nice presentation. You know, in connection with what we're offering tonight, just to let you know, Centier Bank has co-partnered with Lakeshore TV, PBS station here local. I don't know if any of you watch it, but we also have the Plan Council of America. The three of us have put together a television series on Friday nights at 8 o'clock. We started it last spring. I think we aired 5 shows, and we're getting ready now. We're in the process of preparing shows for this fall. And encourage all of you this Friday night, again at 8 o'clock. If you want to be interested in different financial subjects, it's there available for your watching. And I think it's a great investment subjects, lending subject, all about financial planning, stuff like that. Different topics each week. With that being said, we'll talk about tonight's presentation. I'd like to start off introducing our speaker, Rick Milton. Rick is the founding partner of Main Street Advisors. Main Street Advisors is based in Chicago. They manage under just about $3 billion of assets for close to 80 banks, community banks throughout the United States. That's all they do, is they manage assets for clients at the bank. And we've used Main Street for 10 years now. I've known Rick, he's a good friend of mine, and we've had a great relationship. As a managing director, Rick is chairman of Main Street's investment committee. His responsibility also include relationship management, portfolio management directly. Prior to joining Main Street, Rick served as portfolio manager at Feldman Securities Group, where he's responsible for the management of individual and institutional portfolios. Rick began his career at American National Bank and Trust in Chicago as an investment officer. Later, he joined KPMG as a senior analyst in the private equity evaluation group. And then he came in and formed this company with his partners. He holds his Chartered Financial Analyst designation. He's a member of the CFA Institute and the CFA Society of Chicago. He holds his bachelor's degree in economics from the University of Iowa. You know, we'll put up
doesn't play well here
in But he is a big Iowa fan, I know. And also, before I turn it over to him, I'd really like to thank him for coming today, because today is his birthday. Thank you for coming on. Thank you.
Thank you, Bob, for the very nice introduction. And I have to say, this is probably the biggest group I've ever celebrated my birthday with. So thank you for taking the time today. It's a beautiful day. I know that most of you would love to be outside, but I really enjoy this presentation. It's a fun presentation. Even though it says advanced investing, I don't want that to intimidate anybody. We're going to talk about some fun things. And I've broken this presentation down into 3 sections, kind of giving an outline for the night, which I think is always good. The first portion, we're going to talk a little bit about how our minds behave and the investment decisions that we make, and how intuitively we're predisposed to make investment decisions despite analytical advice that we might get otherwise. Given the way our brains are wired, how can we create the most efficient portfolios will be the second portion of my presentation tonight. And then if there's time permitting, I've got someone in the back who's going to hold up his hand when 45 minutes hits. We'll talk a little bit about my outlook for the economy, a little bit about how we're structuring portfolios, and we'll leave plenty of time for questions at the end if that's all right. I think Warren Buffett has a wonderful quote around investing. He says, investing is not a game where a guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control your urges that get other people in trouble. And we're going to talk a little bit about those urges that we all have. Under pressure, our instincts often distort our rational thinking and tend to push us to make decisions that will reduce our anxiety. So if we see everybody selling in the stock market, we feel that we need to be selling in the stock market. It's our natural instinct, right? It's our crowd mentality that we want that comfort. We need to know that we're doing something. A person is smart. People are dumb, panicky, dangerous animals, and unfortunately, we all know it. This largely explains why individual investors have historically significantly underperformed the professionals in the market. There's a company called Dalbar that does a research study every single year. And I just got done reviewing their data ended 2013. What they found over a 22-year period is that an individual investor in stocks produced returns of 3.69% annually over 22 years. That compares to the S&P 500 in that same time period that returned 11.11%. So what is it that the individual investor is doing so wrong as compared to money managers out there? The field of behavioral finance seeks to explain how human behavior impacts our investment results. Each of us, whether we know it or not, have two components of the way we think about things. We've got an intuitive portion of our mind, and we've got a reflective portion of our mind. An intuitive portion is something that just happens without any sort of conscious thought or behavior. I call it the lazy portion of our brain. The reflective part takes some effort, right? There's some thinking that goes on. And so let's use the example. What's 2 times 2? Right? So what happened in our brain? Right? Do we even have to think about it? It just popped into our head. That's our intuitive mind working, right? Now what if I ask you what's 17 times 24? Right? Our reflective mind is kicking in. First we realize it's a multiplication problem, right? Some of us said, okay, 50 is too small, and 10,000 is too big, and no one pulled out their smartphones and did the calculation, right? So I'm impressed there. The answer is 408, by the way, okay? But we don't like to use that portion of our mind, right? We have to engage, we have to think. We like to make things easy and simple for us. So what we saw is that exhausting process of utilizing the reflective portion of our brain. So let's take a look at some common behavioral mistakes that we all make, probably unconsciously, as it relates to our investments, using the intuitive portion of our brain. When we use the intuitive portion of our brain, it's less work. So these are some common mistakes that I've actually put together. And then there's a lot of studies around these, so I haven't hit on all of them. But we're going to focus on the very first one, and that's a mental shortcut. Okay? Interestingly, these all have very scientific real names around them, but I like to make it a little more palatable for everybody that I'm speaking to. So let's think about a real world or example today. If I were to ask the question, which is a more deadly virus, Ebola or the common flu? Each of us might have different opinions and answers, right? Not all of us have the CDC statistics in front of us or a quick Google search to figure out, right, what the answer is. But some of us might actually consider just the news that's been going on surrounding Ebola in the past couple months, and very much determine that because of the prevalence of that news story today, that Ebola is a much, much deadlier virus than the common flu. The fact is that Ebola is not more common as a deadly killer. Ebola, at its very height currently, has unfortunately taken the lives of about 1,000 people, and that compares about 250,000 a year that the common flu ends up taking in a given year. As it relates to our investments, most people simply don't have the expertise or, honestly, the time to find fairly valued securities or to go through the process of look at investments and find out if it's a good buy for them within their portfolios. And as a substitute for good analysis, many people unconsciously, or the intuitive portion of their brain, fall back on a simple rule of thumb or a mental shortcut, and that is what stock is in the news. Doesn't matter why a company is there. Could be the fact that they've just launched a new product. Tesla Motors is a good example of that. Could be large one-day moves, right, up or down, that puts a company in the news and sees the headlines and results in a purchase of that security. Maybe it's even the CEO being accused of some sort of scandalous activity that puts that company in the news. It also explains why politicians, who are oftentimes accused and or convicted of a crime or theft, oftentimes get reelected. Our intuitive mind, as we go to the ballot box, might not recognize 5 out of the 6 names of a candidate that's running, but that 6th person has been in the news. I recognize that name. I'm voting for that person because it's the only name I recognize. Our minds don't want to take that reflective process that might make us otherwise make a different decision. Another common behavioral mistake that we make is stereotyping. Now, I know stereotyping is considered a bad word in our culture. But the reality is that it's a natural way for our minds to process information. Our intuitive mind holds in it an idea of a normal representation of something so that it operates efficiently. People who say they don't stereotype are basically admitting that their brains aren't working efficiently. Here's some examples of stereotypes. Do we have a stereotype of the way an engine sounds in a car? Do we have a stereotype of a way a tree is supposed to look? Do we have a stereotype of a way a farm smells? Yes. That's all of our intuitive mind thinking about normal representation of particular things. Now, in investing, how does that relate? Well, maybe I was at Starbucks the other day, and I had to wait in line for 10 minutes. And I finally got up to give my order, and some surly employee says, "What do you want?" You think you're going to invest in Starbucks? Maybe you were stuck on a cruise ship in the middle of the Gulf of Mexico for 2-3 days. And you come home, and your financial representative says, "You know what? You should buy Carnival Cruise Line stock." Think you're going to do that? It's also the case that these normal representations in our mind prevent us possibly from making a good investment. Because let's use another example. I don't think anyone in this group has had a positive experience with Comcast, right? Yet people still invest in Comcast, right? So hopefully that's our reflective mind taking over, where we may otherwise have had a stereotype over a particular company. Stereotyping actually leads to another thing, and that's a bit of bias towards securities that have performed well historically. People have a very, very difficult time selling investments that have been good performers for them over the years. Even though every single investment that someone makes always carries that disclosure that future results are not based upon historic results, right? They really balk at selling their winners and buying their losers. And this is a very interesting chart that represents some of that thinking, or possibly why we shouldn't stereotype our winners. These two columns are 5-year periods. The first one is July 1st of 2002 through June 30th of 2007. The second column on the right-hand side picks up and is the next 5 years. From the period, the very first period, 7/1 of 2002 through 6/30 of 2007, there were 555 equity mutual funds that were in the top 25% of their category, right? The winners, if you will. How did those winners do the next 5 years? Well, only 110 of those 555 continued in the next 5 years to be winners. Stereotype didn't hold true. And the bulk of them actually fell to the bottom quartile, with over 43.8% being bottom performers in the next 5 years as compared to the previous. Stereotyping led to holding on to those winners possibly too long. Here's another question to consider. Which city in the United States is the vainest? A survey was done by Living Social that asked participants in 20 cities questions like how many people they knew who had cosmetic surgery, and on a scale of 1 to 10, how would you rate your own attractiveness? When I first heard this question, I immediately started putting together my list, right? I mean, first thing that popped into mind was Los Angeles, right? Hollywood. Interesting, LA was number 6 on the list, all right? What about New York? Wealthy fashionistas, right? Gotta be high up there. New York was actually number 9. Chicago, in the humble Midwest, was number 2. And maybe, as a sign of stereotyping, Miami was actually number 1. Now, as part of this study as well, they asked the question, attractiveness, and everybody got to rate their own attractiveness. 56% of all respondents described themselves of ranking 7 or higher on the attractiveness scale. Now, I laughed too. I laughed because I knew there couldn't be that many people as good looking as me. But I think it's a perfect example of overconfidence, right? And how we look at ourselves. Investors who suffer from overconfidence tend to have an overly optimistic assessment of their control over a situation. They believe that their information is correct and everybody else is wrong. It also leads to increased trading activity in general. And there's been a lot of studies and some statistics that I'd like to quote around trading activity. Studies have found that the average individual investor turns over their portfolio 75% in a given year. All right, so if you had 10 securities, you would end up selling 7.5 of them in a given year. Untimely transaction costs associated with this trading and just the untimely nature of making those trades actually reduced performance by 3.7% on an annual basis. Investors who traded the most, who turned over their portfolio 200%, actually reduced their performance by 10.3% in a given year. So on average, the more you trade, the lower your return. Sorry, men in the audience, we are much more susceptible to overconfidence. We've also seen male investment performance in the profession versus female investment performance in the profession go the way of females. that overconfidence leads to more transactions, it leads to lower performance, and men are more susceptible. And it's actually of note, given the predominance of men in the investment arena. Oh. Went too far. Got ahead of myself. Got too excited. Next common mistake I want to talk about is hindsight's 20/20. Hindsight bias is to see events that have already occurred as being more predictable than they actually were at the time. So let's use an example in the investment world. If we look back at the real estate crash that happened in 08 and 09, we can all sit around here and say, oh yeah, I knew that was going to happen. It was so obvious. But how many of us sold our houses and sold our bank stock in anticipation of what we now see as a very obvious state of affairs in the real estate market? A great quote by a gentleman named Montier is that economists are very good at telling you what just happened and not what will happen. Another common mistake that our intuitive mind makes, getting us comfortable, is home field advantage. People are comfortable with what they know, right? It's our intuitive mind working. And unfamiliar situations tend to lead to an emotion of fear. This is likely explains why U.S. investors hold more U.S. stocks. And it's not just something we do. Europeans hold more European stock. Japanese hold more Japanese stock. Just to give you the numbers, if we were to look at the entire world today, the United States represents about 40% of the entire world economy, and the rest of the world 60%. But I'm hard-pressed to find portfolios that have allocations to securities 40% domestic, 60% international. We've got a home country bias, a home field advantage. Familiarity also means that people tend to overweight stocks of companies they work for. And I think in this area, two great examples are BP and ArcelorMittal. I can't tell you over the 10 years I've worked with Centier Bank how much BP stock I've seen in portfolios. Now the problem with home field advantage, while it makes our intuitive mind very comfortable, it can have a devastating impact if something in that company goes wrong. Something in that company going wrong could impact the job of that person, as well as possibly a good portion of the financial worth that that person has invested in that company as well. So breaking out of that intuitive mind and getting away from the home field advantage might make sense. Loss aversion. Many people refuse to sell an investment at a loss. They often mentally account for these as not real but paper losses. Make no mistake, there's no such thing as a paper loss. It's just another form of mental accounting that we as investors who can't cope with the fact that they've lost money put on the loss aversion. On the flip side, there's no such thing as playing with the house's money, that the security has risen so high that you've made so much money. Investors have been found to have a much, much stronger feeling towards losses or regret from losses than the joy they get from the gains that their portfolios increase in value. And a quote that I think summarizes this in a very direct way is that a single cockroach will completely wreck a bowl of cherries, but a single cherry will do nothing to improve the appeal of a bowl of cockroaches. Many investors refuse to sell any investment for a loss because doing so will mean giving up hope, right? Giving up hope that we might get back to even. And this might mean for some people, riding that security all the way to the bottom, or zero. Our intuitive mind being comfortable. And finally, in it for the long haul. This is an investor's reluctance to view a particular investment over the long term. We unfortunately start to narrow the time frame that we evaluate the good or bad of an investment, especially in times of turmoil. It also means we start to stray from our investment plan. It's very, very difficult. I mean, I'm in the industry, and I can't tell you what the market's going to do tomorrow, right? I can tell you what I think the market's going to do over the next year, and I can absolutely tell you what the market's going to do over the next 5 years or 10 years. But I can't tell you what the day-to-day movements of a market are going to be. So investors who attempt to sit out the storms in the market inevitably end up missing out on opportunities. And we're going to see some charts a little bit that absolutely verify that point. So while it's difficult to endure the downside of a market or the volatility that's associated with it, moving to the sidelines means you're going to move out of the opportunity that exists in the future. And stress ends up distorting our way of thinking. This graph represents the panic and maybe the irrational decisions that people make in a very short time period. So for some people, stocks are very, very risky. And I would agree. Stocks are very risky if you only evaluate them over a very short time period. If we take a look at this chart, we see that the likelihood of you losing money on stocks, this is the MSCI World Index, over a 0 to 1 year period, there is about a 40% chance likelihood that you're going to lose money if you evaluate something in a 0 to 1 year period. But what also is interesting is that if you evaluate holding stocks over a 6-year period, the probability of you losing money on those stocks goes almost to 0. And we actually have a real-world example of that currently, right? We all just got done living through the 08-09 Great Recession. It was horrible, right? It wasn't like anything we had seen since the early 1930s. But if we take 5-year periods, even including the worst financial disaster that we all have seen in our lifetimes, stocks are much, much higher today than they were in the previous high prior to that Great Recession. In fact, we know now that the stock market is at its all-time high. So learning to overcome some of these behavioral or intuitive wired brain mistakes can lead to enhanced investment returns. Understanding some of our behavioral biases and working to minimize them can actually provide us an advantage when it comes to investing. Unfortunately, we cannot rewire how we think, and sometimes we really have to fight ourselves not to make some of those instinctive decisions. But we can definitely be aware of how our minds approach the process of evaluating investments. So let's talk a little bit about how we might avoid some of these behavioral mistakes that we just discussed. First and foremost, I cannot stress this enough, but it's important to have a written plan. It doesn't have to be a fancy plan. And we'll get into some of the elements of what makes a good investment plan in a minute. But having a plan and being able to refer to that plan in times of stress or self-doubt, where the intuitive mind wants to take over, is a very calming way of making decisions. The next, as I mentioned before, for all of us men out there, resist the temptation to trade frequently. One of the founding fathers of modern-day finance, Gene Fama, has a great quote. He says, "Money is like soap. The more you handle it, the less you have of it." And in times of market turmoil, our intuitive mind has a need to do something. What we see is that we shouldn't do anything. Humble yourself and avoid overconfidence is a way to combat some of these behavioral mistakes that we all make. Don't confuse success with skill. Deliberately seek out opposing views to some of your thoughts. As uncomfortable as that is, seek other opinions. Here tonight, at a cocktail party this weekend, how many people talk about the losers in their portfolios? Nobody does, right? They only talk about the winners. Don't confuse success with skill. It goes without saying, and we're going to dive into this a lot deeper, maintain a well-diversified portfolio. A well-diversified portfolio can be extremely helpful in managing the emotional side of investing. It can also heighten your emotions, quite honestly, too. Because I'll tell you what, if you have a properly diversified portfolio, there's always going to be something you're complaining about. Something that's going to be losing money. Because if it's not properly diversified, if everything is moving in lockstep with one another, it's not diversified, right? You should always be complaining about something in your portfolio if it's diversified. And then it's a shameless plug, I know. But hire a professional money manager, right? If you feel that you don't want to go through this whole process, right? We go to the dentist for dental work, we go to our attorneys for legal work, we hire professional money managers to handle our finances. So let's talk about how we create an efficient portfolio. This gets into the second portion of my presentation tonight. These are some elements, some basic elements. You could write it down on a cocktail napkin if you wanted to, of what your investment plan should be. What's your time horizon for your money? You got a pool of money, here it is. Set it aside. Maybe that portion is going to be used for retirement. This other portion is going to be used for a vacation. What's the return that you need on that portfolio to achieve those goals that you have for that money? I'll guarantee in times of market turmoil, looking back at that investment plan will help you stay focused and avoid washing the soap, as Gene Fama stated. Your risk tolerance. I think there's certain questions that you could ask yourself with regards to risk tolerance. How would you describe your reaction if an investment went down in value by 20%? What's your overall attitude towards fluctuations in the market? Those are risk assessment questions that you can ask yourself. How much money or distribution are you going to need from that portfolio? Do you need to produce a paycheck for you? It's interesting, in my position as a money manager, I find myself, especially for retired people who have saved very hard, they've hired me to produce a paycheck for them. That's their distribution requirement. That very much drives how we're going to structure a portfolio, and it's going to keep us focused on that goal over the long term. Just some elements of a simple investment plan. Let's talk about one of the other comments of ways to avoid the behavioral mistake, and that is trading or trading too much. This is one of my favorite charts. I can't tell you how much I use this chart. Everybody ask me right now, at this point in time, with the market trading at historic high, all-time high, Rick, should we be selling? Right? We should sell at the high. You know what's going to happen again? We're going to lose it all, right? And you know what? I think it actually does make a lot of sense. We've been in an economy over the past several cycles where we've had this balloon or bubble increase and then pop, and the balloon increased again and popped again, right? The first balloon was technology companies, Cisco, Dell, Microsoft, right? The Beardstown ladies in Illinois making money, remember them, right? Their investment club. Then we had the real estate and banking bubble, right? 03 to 07, right? We all know how that ended. Right? So should we be selling now at the all-time high before the market pops again? We'll get into my economic thoughts in a second. But This is a chart of trading days between 1991 and 2013. That's 22 years. That's approximately 5,500 trading days. That's a lot of trading days, right? A lot. If a client had invested money back in 1991 at the very beginning of the year, they would have achieved a rate of return annualized in the stock market of 9.10%. It's a great return, right? You pick out the top 10 trading days, meaning days that were the best, the 10 best days out of 5,500 days, and your return drops from 9.10% down to 5.40%. That's what you risk in getting out of the market. What did I say? I can't tell you what the market's going to do tomorrow, right? I could end up missing out on one of those trading days. And God forbid I miss out on 10 of those trading days. Look what happens to my return. I don't even have to increase the math that much, right? Look at the 20 top trading days. 9.1 drops to 3%. You lose 2/3 of your return by being out of the market on 20 trading days. And I'll spare going into too much of it, but you basically eliminate 1% or 50 trading days out of 5,500, and your return actually turns negative. So I want to meet the person in the room who can time the market and tell me when those top trading days are. All right? Otherwise, it's our belief that staying in the market is what achieves those returns, avoiding too many transactions. Overconfidence. Here's an example of overconfidence. Does everybody think that bonds can't lose money? Yep, and we should, right? Because over the past 30 years, bonds have not lost money. It's been one of the greatest bull markets for one asset class we have ever seen. The longest and the greatest. 30 years, entire generation of people who think they can't lose money on bonds. Why? Because interest rates have gone straight down over the past 30 years. Back in 1982, can't read that, the U.S. Treasury had a yield of 14.625%. In 1997, that yield had dropped to 4.625%. In February of this year, that yield had dropped even further to 1.60%. Okay? We have seen this declining interest rate environment. When interest rates decline, bond prices go up. That means it's been a bull market for bonds. Everybody who has held bonds has seen an increase in value. Your mother. What happens over the next 30 years? Right? We saw in June of last year, interest rates actually move up for the first time. And people, for the first time in 30 years, realized that you could lose money in bonds. And it was a shock. So having that overconfidence that things will remain the way they are is a behavioral mistake that will not repeat itself. Let's talk about some elements of a diversified portfolio and coming up with the return objective. I'm not going to lie, things are much more complicated today than they were, even when I started my career as an investment officer back in the early 90s. There are many more asset classes in which all of us can invest in. Back in the early 90s, you made a decision between some stocks and bonds. You held IBM, you held GE. It's pretty easy. Now we've got emerging markets, we've got commodities, we've got REITs. What has happened is that assets have been turned into financial securities. And that's actually a good thing, because it provides diversification. But it also overcomplicates things from an investor perspective. There's a wide range of returns that certain investments provide. This is the investment returns of about 12 to 14 major asset classes over the past 10 years. It'd be nice if we would have just held emerging markets right? The entire time, that would have been great. Although you would have fired me as a manager last year, because emerging markets returned a negative 6% last year. When the stock market here in the United States was up 32%, that's a big swing, right? I'd have been gone. Commodities. Why would we want to invest in commodities? Look at those horrible returns, right? Well, commodities actually, we'll see, do a very good job of providing diversification. For all those chemistry buffs out there, we call this our periodic table of investments. Remember that from high school, right? Periodic table of elements. I don't want to get too bogged down. There's a lot going on in this chart. But what I do want to show you is that there's no pattern to this, right? There's no repeatable way of looking at these different asset classes, even among the major colors, right? Dark blue, light blue, gray. It's not like they all are kind of centered around one another. It's not as if all the dark blues, perform well for a couple of years, and then all of a sudden they fall out of favor, and all of a sudden the grays take over, right? That would be logical. That would be stocks versus bonds. But as you can see, there's not a whole lot of logic to the way this table is laid out. That actually is good. It provides us with diversification. So what is diversification? Because I think we find that a lot of people just don't understand what it means to be diversified. Well, to be diversified means that you have assets that are moving not in lockstep with one another, up and down, but assets that are actually moving opposite with one another. Mathematically, it's actually called correlation. And there are certain assets that do very, very providing that diversification. The best securities that provide diversification among large capitalization domestic stocks, or stocks here in the United States, are long-term bonds and short-term bonds. And reading this chart, I can tell you that a negative 0.25 for long-term bonds means that when the stock market falls 10%, long-term bonds are up 2.5%, which would be really nice when the market is having a very, very difficult time. That's what diversification is. I mentioned commodities, right? Why would we want to invest in commodities? We saw, right, a couple slides ago, some pretty meager returns. Well, commodities actually do a pretty good job of protecting at least large company stocks here in the United States. And they also have some diversification benefits in some of the other asset classes as well. So a graphical representation of a narrowly diversified portfolio, something that has too few assets, or not enough assets that are moving in opposite direction of one another, means that a 50-50 portfolio of a narrowly diversified portfolio is going to move in lockstep with those two assets. And it's only when we introduce assets that are non-correlated with one another do we start to see them move separately. Let's talk a little bit about building a tax-efficient portfolio in the realm of our behavioral finance world. Who likes paying taxes? Nobody, right? Nobody. So what I've represented here is the capital gains rate of stocks historically. In fact, this goes back all the way to 1964. So for very, very wealthy people, currently the highest tax rate that they pay on capital gains is 23.8%. Or they pay 18.8%, some people pay 15%, some people pay 0%. It all depends on how much people make anymore. The bottom line is that taxes today are, A, historically still low, but a bit higher than they were at the end of 2012. And given the fact that they are higher than they were at the end of 2012, they become that much more important in how we view investments. So what is the impact of taxes? Well, it's unfortunate, but there is an impact. For stocks, since 1926, you would have received a return of 10.1%. But on an after-tax basis, you would have only taken home 8.1%. For bonds, you would have returned 5.5% since 1926 and only taken home 3.4, 3.5 for cash, 2.2 after tax. Interestingly, taxes impact bonds and cash that much more, proportionally. And the reason why is that the interest that bonds and cash produce are taxed at your ordinary income tax rate, not the capital gains rate that dividends are taxed on in your stocks. So we very much believe that you all as investors who probably have an IRA or 401k through your employer or rolled over from another organization, and may also have some investments outside of an IRA, titled in your name personally or jointly with a spouse, that you all benefit from putting certain assets into certain accounts. And if we take a look at that, there are certain assets among stocks and bonds that should go into your tax advantage or your IRA or 401k account, as compared to your taxable, your individually named or your jointly named account. All things being equal, in a very simple version, would be if someone had the goal of a balanced objective, half stocks, half bonds, and two portfolios of equal size, one in an IRA and one in their individual name, all their bonds should go into the IRA, and all the stocks should go into their individually named account. All the bonds and the interest that it produces would not be taxed, where more normally in a taxable account it would be taxed at your ordinary income tax rate. 28%, 32%, 35%, 39.6%. All much, much higher than the capital gains rate that you would find on stocks, which would be in your taxable account, which at a maximum would only be 23.8%. I got the 45-minute warning about 5 minutes ago. I'm going to finish up the third portion of the presentation, just talk real briefly about our economic outlook and how we're positioning portfolios. I'll move through this a little quick, and then we'll kind of roll it into some question and answer at the end, if that's all right. So currently, you'll see it in your packet as well as on the screen. We are very, very optimistic about the economic environment here domestically. I know that there's going to be questions at the end with regards to employment and how so many people can still be unemployed, yet the economy doing well. But by all measures, our growth of our country and the GDP that we're producing is actually very, very strong. We had a very tough start to the year this year. As all of us know, the weather was pretty bad around here, right? And that singularly led to our economy contracting in the first 3 months of this year. But what we have seen was there was so much pent-up demand from that contraction that we've actually roared back. And in fact, the second quarter GDP number was significantly higher than all those economists who I complained about earlier had predicted, with GDP rising over 4% in the second quarter of this year. Interest rates remain low, okay, Fed funds rates. And they're going to remain low for a very long time. The Fed has indicated that they are not even interested in raising rates until possibly the second half of next year. Inflation, right? we're not concerned about oil prices and gas prices right now. I mean, August is the time where we normally, start complaining about gas prices, but we're not, right? Production in this country has never been as high as it is today. We have what's going on in our country, a real energy and manufacturing renaissance. We've seen the statistics. It's not the United States in some sort of bias, but we will be oil independent in this country by 2020. And it's amazing. That's only 6 years away. And in fact, if you look at some of the statistics where certain states, North Dakota, Texas, are already ranking in oil production well ahead of whole Middle Eastern countries with some of the technology that has come into the drilling process. Employment is improving. There are actually some statistics out there right now that indicate that in certain areas there are labor shortages going on. And what has happened is that as people have lost jobs through the Great Recession, not all have repositioned themselves through education and skill building into areas where there are jobs availability. And so in those areas of jobs availability, there truly is a shortage at this point in time. The US dollar remains strong against foreign currency. Housing, while very robust last year, has settled down into a more normalized environment, which is good. And international economies is probably why we're most optimistic about the United States and its economy. Because the US versus Japan, versus Europe, versus China, truly is in the best shape among developed country economies at this point in time. So, in a strange sort of way, we are the pig that smells the least at this point in time. So how are we allocating portfolios currently? Well, I talked a little bit about overconfidence earlier, right? That history won't repeat itself, and I alluded to the fact that this rising interest rate environment is going to negatively affect bonds in the future. Along those lines and that thinking, we are underweight, more generally, our fixed income or bonds within portfolios. We believe that interest rates would have already risen this year. In fact, they have fallen off so far this year, somewhat unpredictably. But we do believe that interest rates will continue to rise. And part of it is that as the Federal Reserve raises interest rates, we will start to see that impacting bonds and bond prices within portfolios. We're overweight equities or stocks favoring domestic securities as compared to all of those other international companies I just mentioned. And alternative investments. This is an area that provides a lot of diversification. It's a lot of the areas that I talked about that moves opposite of stocks and bonds. We remain neutral on. We think that they provide downside protection and diversification, yet we're not at a point where we believe we need to overweight those securities. Probably complicating matters and showing you that things are so different than even when I started my career is that even though we don't like bonds as a general investment or fixed income, there are so many different asset classes that represent bonds today that actually there are certain categories that we think are attractive. And so if we take a look at some of the assets that we're at least overweight or neutral on, tax-exempt bonds are municipal bonds. So, for all of those Indiana people who only want to buy and support Indiana debt, I think it's a great time to hold municipal bonds, especially for those who pay taxes at a very, very high rate. We think that corporate bonds are attractive and have a neutral weighting to them. We also find senior floating rate bonds, bonds at the very bottom of this list, bonds that actually increase in value as interest rates rise, is a very attractive asset class at this point in time. Among stocks, the first three being all domestic. We are modestly overweight large and middle-sized companies in this country. We think it's a great time to hold the GEs of the world, the Apple Computers of the world, the Johnson & Johnsons, the ExxonMobils. We think it's a good time to hold the middle-sized companies. It's a little harder to name those. I always go to Nordstrom's department stores, a middle-sized company. And we're neutral to small company stocks. I could name small company stocks, but I wouldn't even know what they did some of the times. And internationally, we favor developed countries. We favor countries like Australia, New Zealand, as compared to some of the emerging markets like Indonesia and Singapore with regards to international investments. And finally, among alternative investments, we're neutral real estate, which, by the way, I wish we would have been overweight at the beginning of the year. Through the first 6 months of this year, real estate is the best performing asset class. Right? Again, I couldn't have predicted it. Real estate in the first 6 months of this year are up 17%. Nice return for a 6-month time period. That's why you diversify, right? Okay? Diversification. You're always going to have something you're happy about, and there's always going to be something you're complaining about. Commodities, not complaining too much about them this year, but they haven't done a whole lot. And finally, hedging strategies. I won't go into too much detail. These are assets that are intended to provide downside protection. Something that at this point in time, being so constructive on stocks in general, we don't feel like we need a whole lot of exposure to. So with that, I would love to answer any questions that you all have.
Do you have an opinion about diversification of using, I'll give you an example, using ETFs or small to large equities, so forth, various types of bond ETFs versus a ETF that covers the broader market? Do you have any insight into whether you would go with the individual type or the broader market index type?
So the question is, and I'll first define what an ETF is for everybody. The question is, do we have a favoritism towards individual asset classes of ETFs, which stand for exchange-traded funds, or do we prefer just some sort of global allocation to all asset classes through an ETF as well? So first and foremost, an exchange-traded fund is like a mutual fund that trades throughout the day. So a stock trades throughout the day, and so does this mutual fund that's called an exchange-traded fund. A mutual fund, by comparison, only trades once a day at the very close of the market. So a mutual fund gets priced at 3 p.m. Central Time every single day, whereas an exchange-traded fund gets priced throughout the day. There are benefits and there are consequences to each. I can tell you that 401k plans and IRAs should only use mutual funds, whereas buy and hold strategies are very much advantaged by exchange-traded funds. Answering the question, we do not have a preference with regards to breaking out individual asset classes for an ETF. What I would tell you, especially for all of you who may be doing your investment on your own, I would suggest for simplicity's sake, buying that one exchange-traded fund that may encompass a larger and broader capital market as compared to going in and weighting each individual asset class. Okay. I'm glad I verified your list.
I like your opinion on annuities, different to variable annuity, or just in general, what do you think of annuities?
Sure. I will say that I'm just not an annuity expert. I would actually manage the assets that an annuity company would collect as a money manager. I think that annuities serve a purpose. I think that annuities serve a purpose from the perspective that we live in a world that no longer has pensions providing for us in our retirement. That steady stream of income every month that might come from a pension more normally. So I've seen the most efficient use of annuities where a portion, not all, but a portion of assets creates that own personal pension, whereas another portion is a professionally managed individual asset account. I'm probably not saying anything you don't know already. I think the key with annuities is just to evaluate the fee structure around them. Everybody wants to get outside this beautiful weather. Go ahead.
What was your outlook on bank stock?
My outlook on bank stock. Do you own Centier Bank stock? I have a very favorable outlook of bank stocks today. I think certain bank stocks are more attractive than others, and I think that's a very political answer. I don't think bank stocks have increased in value proportionately with the other growth in other sectors. I think they're a bit behind, so I think that there actually is quite a bit of value that is still yet to be had as our economy expands in the banking sector.
We have a new shorter title, is Yellen, the lady chairman.
Janet Yellen, Chairman of the Federal Reserve.
Okay, and prior to that, we had
Ben Bernanke.
okay. Both, she came under kind of his tutorage, I guess. What do you see? Is there a major change going forward from what he was doing to what the future holds?
The question is with the change in Federal Reserve chairmans from Ben Bernanke to Janet Yellen, is there a major philosophical change that will occur? The answer is no, at least from what we've seen. She'll touch our money less, right? What I would say is that there was probably a larger shift philosophically when Alan Greenspan left the post of Federal Reserve Chairman and Ben Bernanke came in. And probably most notably, not necessarily the investment policy, but more the transparency or them telling us what they're viewing and seeing and what their intentions are very much changed under Ben Bernanke. So it used to be people like me would literally wait to get that transcript of the Fed's Open Market Committee minutes, and we would speed read through it, trying to glean out any pieces of information. That would be an advantage to any of our clients. Whereas now, it's a very much an open book with regards to the metrics they're looking at, so I can look at them too, and what their game plan is based upon those certain metrics. So I do not think that there's going to be a big change. Please.
In regard to hiring a professional money manager, just a little research that I've done, a lot of companies won't, I guess for an average Joe, they like to deal with higher dollar amounts. Is there something that's more, do you recommend anybody as far as a money manager goes that it is feasible in
Right.
a smaller bank account, so to speak?
Yeah, I think that's a great question, and I know that's always a struggle. And I think that it's not always true that people are looking for high dollars and trying to service only high net worth individuals. I can tell you that here at this institution, I can tell you I've got portfolios that I manage that are $10,000, and they might be associated with a family relationship of other dollars and things like that. But the one thing I would tell you and encourage you in evaluating a money manager is to seek out a fee-based money manager as compared to a transaction-based money manager. So a fee-based money manager is someone who charges a percentage of the market value of your assets. So if your portfolio goes up, they make more, right, because it's a fixed percentage of those assets. And they sure don't want it to go down, right? Because they make less, because it's a fixed percentage of the assets. Whereas transactional based does not have as much tie to the overall market value. So that would just be my advice in the selection of a money manager. And that said too, for smaller accounts, I think there's a lot of very good educational materials out there. And there's companies who specialize in those sort of accounts, like a Vanguard. I think does a very good job in providing some educational materials, along with at least helping people get started efficiently managing their portfolios.
Something that I've been toying with mentally, if you've been with a company-based donation,
401k.
or 40%,
I'll repeat the question in a second.
and so if you accumulated quite a bit, then it makes you think about, okay, when you make the transition out of the working environment, do you seek out a money manager? Do you consider the fees that they charge? Or do you stay with the not so well managed in the category we just discussed?
Right.
And go for the low management fees?
Right. So the question is what do you do when you have accumulated this 401k pool of money and now you're going out and you're deciding to retire, right? Do you seek out a professional money manager to help you with that? Or do you stay within possibly even the framework of that company? Because by the way, some companies do allow you to keep your money in that pool, that 401k pool, even after you've left that company. My advice, obviously, would be to seek, professional money management. People are living longer; they need their financial assets to last longer. Back in June, my grandma turned 100 years old. Right? I mean, past generations, some of their retirement thinking was, "Oh, I'll inherit money. That's how I'll get my retirement." Right? My dad's 73, he's already retired, right? He figured it out. We can end up living a real long time in retirement. And so it's important to, I think, get some sound financial counseling with regards to not only investments, but even what's that paycheck that you can take from your financial assets in retirement.
We've got a couple of REITs which have dropped in their share value, even though we're still getting the distribution that we've always had. But do you see the share value increasing in the foreseeable future on those?
Return on capital? The question was, they've seen the share value in some of their REITs, which stand for Real Estate Investment Trusts, which, from my previous slide, right, those should all be in our IRAs because of the way they're taxed. That they've seen a reduction in the number of shares, but the market value has increased. Is that correct?
No, in other words, when we bought into it, it was at a certain dollar amount.
Yes.
But
$10.
now-
I'm just making that up.
Yeah. Now that value has dropped. They've lowered it probably about 25%.
Okay, so our REIT was at $10 and now it's fallen to $7.50.
But our income off of it has remained the same, so they're paying us a higher percentage on the lower amount, basically.
Yeah, so I would suggest evaluating what that REIT is invested in, because a REIT that falls from $10 to $7.50, right? Basically the entire portfolio of properties, because that's what a REIT is, it's a portfolio of properties, has been assessed to be not worth as much. Okay, so again, I'm not making any assumptions, I just don't know what it's invested in. But mathematically, right, if you look at the yield yield is always showing a percentage, right? So let's go back to 4th grade math. Numerator, denominator, right? So if the numerator, which is your income, remains the same, but your denominator, which is the price of that REIT, falls, what happens to the percentage yield? Goes up, right? So back during the financial crisis of 08 and 09, right, the Bank of America's, at least initially, before they had to start cutting their dividends, all of a sudden had these dividend yields that were through the roof, right? Because the price had fallen so much and the dividend had remained the same, at least temporarily, that all of a sudden we found some of these bank stocks, which more normally might yield 4%, 5%, 6%, were all of a sudden yielding 15%, 20%, right? You haven't made any more money because it's just a percentage. I would just reevaluate what the properties are that it's invested in.
Okay, on behalf of Centier Wealth Management Department, we'd like to thank Rick for coming this evening.
Thank you.
Thank you for taking the time, and thank you all for coming. We really appreciate you being here, and